Hey guys, Joe Frank here, market analyst for YouTrading, and in today's educational video, we're going to be explaining why the market has reacted how it did in wake of the latest US jobs numbers. So first of all, let's just quickly take a look at the jobs numbers. What do we get? In the month of December, 223,000 jobs were added to the US economy, according to the US Bureau of Labor Statistics survey. That's above the expected 200,000, okay? So better than expected job growth in December. Okay, although we did get a slight negative revision for the month before, but 256,000 still strong, 223,000 still strong. Like when you're talking about more than 200,000 jobs being added a month, you're still talking about really a labour market that is booming. That's historically been the case anyway. Unemployment rate, you can see here, fell more, well, actually, no, unexpectedly fell to 3.5% from 3.6%, which was actually revised down from 3.7%. So more evidence that the labour market picture is looking pretty good. And then you can see here that the participation rate ticked up slightly to 62.3 from 62.2, which was revised up from 62.1. So all of these metrics are good, but average hourly earnings growth grew at a slower pace than expected. Okay, month over month, it was 0.3% below the expected 0.4%. And last month's or November's month over month average hourly earnings growth was revised down to 0.4% from 0.6%. So wages in the last 2 months growing slower than expected. And that's also reflected in the year over year metric as well. 4.6% year over year growth in wages, down from last month's 4.8%, which was revised down from 5.1%, below the expected 5%. So, yes, jobs still being created at a good pace. Measures of labour market slack, like the unemployment rate and the participation rate, also looking stronger than expected. But the pace of earnings growth slower than expected. Now, that's a key factor because as far as the US Federal Reserve, the central bank of the US, is concerned, the inflationary aspect of the labour market is wage growth. Now, if you have very high wage growth, that's seen as being inflationary. So the fact that it's come down to 4.6% year over year is going to be a positive as far as the Fed is concerned. And that leads us to talking a bit about the market reaction. So let's look at this CME Fed Watch tool, which looks at option market pricing and gives you a sort of estimate as to what probabilities markets are pricing for the Fed's next interest rate hike. You can see that. So the interest rate range is currently 4.25 to 4.5%. A 25 basis point rate hike to 4.5 to 4.75% is now seen at 65.1%. That's at the meeting, which is in 26 days. 65.1%. Now, yesterday, the odds of a 25 basis point rate hike were about 2.5% lower. And then you can see it's also the odds of a 50 basis point rate hike have been revised about 2.5% lower. So basically, markets slightly betting more in favor of a 25 basis point rate hike than a 50 basis point rate hike in wake of these latest US inflation numbers. In terms of the market reaction, the change in that pricing is not that big. So the market reaction equally hasn't been that big. I can show you the dollar index. This is 5-minute candlesticks. You can see when the data came out at 1:30. This is Greenwich Mean Time that they're using on this chart. 8:30 Eastern Time. We did see immediate downside, and that is continuing for now as the US session. It's still the morning in the US session, but as it gets underway, US stocks are pushing higher, not massively higher versus their pre-data levels. How much higher? Well, yeah, nearly 1% up from pre-data levels. If you want to look at things like gold moving higher, dollar weakening, yields also falling. That's generally a positive for gold. Gold currently around 1.2% higher versus pre-data levels. Crypto also going to be gaining a little bit on that dollar weakness in yields, slight strength in stocks. Why are we seeing this market reaction? Well, When you see hawkish Fed bets being revised down, which we've modestly seen in wake of this data, that reduces the yield advantage of the dollar, which causes outflows from dollar denominated assets, like bonds, basically, into the bonds of other currencies, because that difference in the yield narrows a little bit. So markets respond by moving things around, basically, to optimize portfolios. There's also the fact that with stocks rising, when we're talking about a less aggressive or a slightly more dovish Fed, we're reducing downside economic risks to growth and thus also towards earning growth. And we are boosting multiples by decreasing expectations about what the long-term discount rate. So that's a positive for stocks. And, when you see risk assets like stocks, and I just showed you crypto rallying, that is generally a sign of risk appetite, which weighs on safe haven assets such as the dollar. So yeah, that's pretty much what's going on. Let's go back and have a look at some of these asset classes on a slightly longer time horizon. You can see that in the last couple of days, the dollar's been picking up from recent lows, but this latest data could keep the dollar in its longer term downwards move that has seen it already pull back, like how much from the September highs? Probably about 8%. No, closer to about 9% now back from the September highs. If we are talking about an eventual Fed pivot as inflationary pressures come rapidly under control, which they do look like to be doing, and everyone's thinking about a recession in the US as well this year, the Fed's eventually going to have to pivot in a dovish direction, and a lot of that is being priced in at the moment by the market, which is why we've seen the dollar get battered like this. But there's potential further room for that move to get going, specifically when we start talking about Fed rate cuts. First pausing, then rate cuts. And it's like, how quickly do those come? But as we move towards that, you're going to see the dollar potentially falling more. In terms of US stocks, still within recent ranges, because it's like, yes, maybe the falling inflation and the weak growth outlook is going to push the Fed to finally pivot in a dovish direction at some point later this year. But we're still talking about a recession. We're still talking about earnings growth probably being quite weak. We've got a lot of big tech companies laying people off. It's still an uncertain time to be buying stocks for that reason, basically. And, valuation multiples, there's probably not the best argument for them to push massively higher in this moment. So stocks very much still within recent ranges. We're going to have to see what happens there. And we can quickly let's have a look at gold, actually. A little bit more interesting. Gold continues to push higher as the dollar weakens, as yields fall in anticipation of this dovish Fed pivot at some point later this year. Looks like the gold bulls are intent on hitting this resistance level in the form of the June highs around 1880. Whether we can have the big push above that level and towards these highs from March 2020 remains to be seen. But if we're talking about a recession and the Fed going a bit more dovish, gold is almost the perfect safe haven asset for that kind of economic environment. So maybe it's not too surprising if we could get back and test this double top sort of all-time high that we have from 2020 and then early 2022. But yeah, guys, that's pretty much the video. I hope you enjoyed it. I hope you found it informative, and I'll see you all in the next one.